Welcome to the Money Over 50 podcast, brought to you by Dallas Davison and Michael Hogue from Money Over 50 Financial Advisors. This information is general in nature and does not take into account your objectives, financial situation, or needs. Therefore, you should consider whether the information is appropriate for you and your personal circumstances. If you require personal advice, please contact Money Over 50 Financial Advisors. Here are your hosts, Dallas Davison and Michael Hogue.
Welcome to Money Over 50 with Dallas and Michael. Dallas, your topic today, why you shouldn't fix your interest rates. And you're talking about loan interest rates here, aren't you? You're talking about the standard home loan interest rate or the rental property interest rate.
I am. Yes, thank you. I was actually going to preface that with this actually should be a very short podcast because that's only what we're talking about. If you've got some $100 million loan facility for some business that you're in or something like that, you probably should be taking advice from an actual loan specialist, not some lunatic like me on a podcast that's geared towards people over 50 getting set up with their personal finances for retirement. So, yeah, great point there. We're talking about your home loan, your investment property loan, those sorts of things. Now, where this sort of came, why this is sort of relevant is for a lot of people, I think what's happened is as interest rates have come down, there's a lot of our clients and people of our age of client that have lived through very high interest rates, and they remember those 15, 17% interest rates. So as they see those loan rates coming down to 4%, 3.5%, 3%, there's almost an instinct to grab that and to and I can understand why, and to lock that in and go, I never thought I'd be able to fix my home loan at 2.98% for 2 years. This is just amazing. Like I have to take advantage of this. I just feel like I don't want to let go of that and let it sort of drift back up. But basically, the theory that I've got here about why you just should never fix your home loan interest rates is that there's a price to that that's built into what the banks offer. Again, this is one of those things, if you think about this logically, NAB isn't offering you a fixed interest rate out of the goodness of their heart. They're doing that because they know that for some people, the fixed rate is more important to them. Having that stability, having that locked in, is more important to a lot of people, or some people, than actually getting just the pure cheapest rate. So, on average, I would say, as a rule of thumb, fixed interest rates are, would you say, 0.5% dearer than your variable rates?
Yeah, look, there's obviously different terms and different periods of time and different stages through the interest rate cycle, but that's a fair assumption, I think. 0.5% is probably about right.
Yep.
It's really a little bit like an insurance premium, isn't it?
It's exactly
it's like you're paying 0.5% more for the insurance premium that the rate won't go up. Now, it's a either or scenario. The rate will either go up or the rate will either go down.
Yeah.
So people don't often. I find they don't often take into consideration the other side of that,
yes,
which is that there's a chance that the rate will go down as well. So the variable rates will go down.
The loss aversion thing, where if interest rates are at 3% and you can lock it in at 3.5% for 3 years or 5 years, we're worried about the rate going from 3% variable to 4% variable. We know that we'll feel that pain of when we're paying 4%. We'll be kicking rocks, going, I could have been only paying 3.5% on this, and this is unfair, and I should have done that. Whereas, as you just said there, it can go the other way, and there's nothing magical about low rates that, as we've seen for the last 10 years, that just because a rate is lower than what it was doesn't mean it can't keep going down. So, if you lock in at 3.5% when the variable rate's at 3%, and then that drops by 0.5%, it's still the same cost. It still costs you that what you've given up there is the same amount as what it would have cost you if that rate went to 4%. So that's, I guess, the first thing is to start is that on average, fixed interest rates have to be higher than variable rates. That's just, again, if they weren't, NAB wouldn't offer those fixed rates. There's no reason why they would give you stability, peace of mind, all these things for no cost. They wouldn't take that risk on.
You're 100% right there. And if you actually extend the term out, like the rate actually goes up.
Yes.
So if fixed rates now for 1 year are 2%, over 2 years they might be still 2%. Over 3 years they
become 2.4, and then
it becomes 2.4, and then over any longer than that, it's coming to to the high twos in that example. So at the risk of hijacking your topic,
no, you go.
There's a couple of things that I've always thought of, and one is a 12-month fixed rate is absolutely useless. Because it just flies by that period of time.
Well, I would argue that a 5-year fixed rate is absolutely useless.
And a 5-year fixed rate is so much higher than the current variable rate.
Yeah.
Generally speaking, that I think it's
So in that case,
again, besides the point, so you're picking somewhere in the middle usually if you're fixing in.
Most people tend to pick a 3-year rate. Or something 2 or 3 year, and they go, okay, well, my variable rate's 2%, my 3-year rate's 2.4%, it's only 0.4%. I'll sort of wear that extra cost because then I not have to worry about interest rates the next 3 years. So, I guess my theory on why there's a number of reasons why I don't think it makes sense is that number one, you are incurring that extra cost of 40 basis points. 0.4% is the extra cost. Now, in theory, if you're one of the things that you could do is you could just go, I'm going to pay that extra 0.4%. I'm going to pay that off the principal loan. I'm going to keep it on a variable rate. I'm going to pay the extra 0.4 off the principal. And I know it's like you said before with insurance premiums. I know that in 3 years' time, I have paid that much off my loan. I've paid an additional amount off the principal of that loan. Even if rates have gone up a bit, I know how much has come off there anyway. I'm likely to be better off to the tune of that amount. So that's kind of why I think if you're going to fix for 3 years, it doesn't really make that much sense. You could just take the extra cost saving and pay it off the loan. The second part of it to me is that most people, you're not normally fixing a rate that's going to stay the same until the loan's paid out. Most people that they might have a $200,000 home loan and they're fixing it for 3 years and they're paying $30,000 a year off it. You're still going to have $110,000 left at the end of that, separate to the calculation of how much interest and principal you've paid off. But it's not as though you're locking in the rate that you're going to pay for the lifetime of that loan. So you still have the same issue in 3 years' time, where whatever's left on that loan, if rates have gone up, you still have the higher rate to pay on the remainder of the loan anyway. So I guess that's to me one where the only time emotionally that could make sense is if you go, I've got 5 years worth of I'm going to be able to pay off this loan in 5 years, and I want to lock in that rate, and I know what I need to pay every month in order to have it squashed within the 5 years.
Look, the other thing too, that if you again using the 3-year term as an example, so if the current variable rate was X% and the 3-year fixed rate was 0.4% higher. To be out of pocket, what would actually have to happen over that 3-year period is that interest rates would need to go up on the variable rate by 0.8%.
Yes.
And the reason for that is that whilst you're on the variable rate and it's 0.4% lower, you're winning.
Yes. Yep.
At that point in time.
Yeah.
Yeah. If rates do rise,
yes.
Even if they only rose by 0.4% over that 3-year term,
you've had that period of time.
You would have had a period of time where you'd paid
less
under
yes.
what the fixed rate was. So the fixed rate, whatever the margin is, whatever the gap between the variable rate and the fixed rate is that you're locking in over that term, rates have to rise by double that amount effectively for you to be out of pocket, generally speaking.
Assuming that happens halfway through. It gets into
I've just never ever seen rates rise by 1%. like they do.
Yes,
I mean, the Reserve Bank meets on the first Tuesday of every month.
Yes.
And they can technically adjust interest rates. And I mean, individual profitable banks can raise or lower at any point in time as well. But usually it's set by there's some sort of benchmark back to what the Reserve Bank of Australia sets as the rate. Now, you just never ever see them. They're usually stepping it up or down in 0.25%, quarter of a percent steps, and then they pause and they see what data happens. Comes through, and then they adjust again. So, I mean, very rarely do you see. Anecdotally as well, I'd like to add. So, in the last 20 years that I've been in this industry, I've seen countless occasions of where people have actually fixed in rates, and in recent years, rates have been coming down. So anyone that's actually fixed in has it's been a natural tilt to the fact that they've actually lost out in that equation because rates have. But in the first 10 years of my career, there was rates that were all over the place. So there were rates that are going up, there were rates that are coming down. There was a period of time where rates went up and rates came down. I've hardly ever seen people get the fixing in equation correct, even in rising markets of interest rates. And here's why I think that is the case. It's a little bit like changing their investment strategy, their superannuation fund. It's done reactively. So what happens is that interest rates are sitting at 3% and they're on the variable rate, and then over a series of 12 months, what happens is the Reserve Bank of Australia steps up by 4 times a quarter of a percent. So that the rate's risen to 4%, and that's when people usually fix in. And they're fixing in then for a 3-year term. And instead of fixing in at 4%, they're fixing in at 5.5% for that 3-year term, or if it's even longer than that, it's higher than that. And they're doing it reactively, and that's why I've just my belief is that I've hardly ever seen it right because of the fact that they're actually doing it reactively. Well, we're agnostic to what interest rates, what people do on their interest rates, like what we wanted. When we're looking at things, we're saying, we get asked the question a lot of the time. Would you fix in or would you go variable? And we always say, we'd go variable most of the time. In fact, all of the time, playing the statistics and relying on the statistics of the average of the variable rates are consistently lower than the average of the fixed rates. And look, we're more about having a workable plan to pay that loan off and down and out by the time someone retires. So we're really agnostic to what someone's decision is. And so I've just hardly ever seen anyone get it right when they've decided to fix in.
Well, the thing about it is, again, you got to think who's on the other side of that trade. So if you as the individual think, even if you are trying to time the bottom of that and go, I think rates are going to go up, I'm going to go to NAB and fix my interest rate. NAB's not, it's not like they're not thinking about what interest rates are doing in future. So if you think interest rates are going to go up and NAB thinks interest rates are going to go up, NAB is just going to raise the price of their fixed interest rate home loan. They're just going to. It's exactly the point that you just made before, Michael, about trying to time investment strategies. Is that when all of the information is readily accessible to all of the people. So if you think that you're going to fix in at a rate that you're going to sort of get one over NAB, it's highly unlikely. I mean, if you think about how much time and energy they would be spending on trying to forecast where interest rates are going, and again, a good bank is actually agnostic about where that rate is going because they're just building in their margin. But they're not going to let you fix in a 5-year rate at the variable price if they think that interest rates are going to go up over the next 5 years. They are going to make you pay extra so that they're not out of pocket over the next 5 years. So that's, I guess, the first part of that is you always got to think about who's on the other side of that trade. Like your bank isn't out to catch you out in any way, but they're just going, well, if you want that stability, you want that certainty of what that repayment is, you have to pay us for the extra risk that we're taking on board there. And I think that's the last piece of this I've been thinking about is that I'm not saying here that you shouldn't fix rates because rates stay low. Obviously, in the last few years, rates have been low. There is no reason that interest rates can't continue to go down, but there's also no reason rates can't go back up to huge amounts. So I'm not saying don't fix your rates because I think that it's not a market call by me on where things are going. I'm just making a statement around on average, the variable loan is going to be cheaper than the fixed loan. And
it's a good point to point out. We are not saying we can predict the future at all.
No,
and you could fix in right now and you could win out of that equation.
That's right.
You could fix in and you could lose out of that equation.
Yeah.
What you're saying and what we are saying is that if you take 100 people and 100 of them are fixing in interest rates over various terms, more of those people than not are going to lose out in that equation.
Exactly right.
Over the next period of time.
Yeah. And I guess the one final thought before we wrap up is where I've heard people, mortgage brokers or people in the industry, where I've heard them recommend you should fix your rates is, for example, people where your budget is really tight and you can only just meet your repayments, and they kind of go, well, it doesn't matter if on average you'd be better off because if rates go up by 0.5%, you won't be able to meet your mortgage repayments. What I would say to that is that if your budget is so tight that a 0.5% rise in interest rates is going to wipe you out, you just shouldn't be taking on that much debt in the first place. This is a big one that we've seen with more so with younger couples that are borrowing 95% of the value of their property, and they've only just got enough spare cash flow every week to make the mortgage repayments, and they sort of feel like they have to fix the interest rates because otherwise if it goes up they won't be able to meet it. They just shouldn't be buying that property in the first place.
It's a strange one for me because they'll be 27 years of age and they'll lock themselves into that and they'll fix because they can't afford any change to their income. But then they'll also tell you in 3 years' time they want to have a baby.
Yes.
Yes. Well, that's going to be a big disruption too. It's going to be more an increase to your expenses.
Yeah, and
a drop in revenue. So maybe you rethink how much you're actually borrowing in this situation.
That's right, and I think that's the point. For obviously that's relevant for younger people, but even for people in their 50s, you got to have that same attitude of if you're approaching retirement and your cash. We've spent a lot of time in all these podcasts talking about how valuable it is to have some free cash flow available to make these contributions into super and to build up your retirement savings. If your budget is so tight that a change in interest rates you're not going to be able to meet your loan repayments, I would question whether you can actually afford the loan that you have. And that's, we've talked about this a lot in the past about potentially if you've got so much house that all of your cash flow is going towards the mortgage repayments, maybe you've got too much house. Maybe you should be downsizing at that point in time, trying to free up some of that, trying to get rid of some of that debt, free up a bit of cash flow to either put into super or get rid of the rest of the debt, rather than trying to scrape through. Because, again, there's an end in sight. Like you said with the young couple that in 3 years' time they want to have a baby, what are they going to do then? If you're 55 now and you've got a relatively high home loan balance and you think, well, we want to work for another 5 or 10 years, unless you are going to be able to squash that loan over the next 10 years, you are going to get to retirement and have some debt left over. So fixing your rate for 3 years doesn't really solve the bigger issue of how am I actually going to get rid of this debt in future. And you may have a plan for it, and if you do, fantastic. But if you've got a plan to get rid of the debt anyway, then why not pick up the cost saving on the variable bit on the way through? But yeah, I think that's sort of the other part of it to me is that some people find themselves in a situation that's they might have taken on debt at a time when their income was higher and it was easy to meet that, and now things have changed, their income's dropped, and they sort of, everything feels very tight, and they have so much debt that they feel like they need to fix that interest rate. I would say that that's a short-term fix to a long-term problem there, and you really need to look at the underlying cause of how much debt have I got versus how much spare cash have I got, and is there another way that I can solve this problem rather than just fixing my rate?
Thanks for listening.
Thank you for listening to the Money Over 50 podcast with Money Over 50 Financial Advisors. We look forward to catching up again soon.